Hello, everybody. Thank you so much for tuning in today. This is the Bodega Cat Book Club Financial Edition. And today we're going to continue our reading of The Creature from Jekyll Island by G. Edward Griffin. And today we'll be starting chapter 4, and this will be part 1. Okay, I want to move the camera in just a little bit here so you guys can see. And if you have a book, you could follow along with your book, or you could follow along with us here, whatever works for you. Okay, so here we go. Chapter 4, Home Sweet Loan. The history of increasing government intervention in the housing industry, the stifling of free market forces in residential real estate, the resulting crisis in the S&L industry, that's saving and loans, the bailout of that industry with money taken from the taxpayer. As we have seen in previous chapters, the damage done by the banking cartel is made possible by the fact that money can be created out of nothing. It also destroys our purchasing power through the hidden tax called inflation. The mechanism by which it works is hidden and subtle. Let us turn now from the arcane world of central banking to the giddy world of savings and loan institutions. By comparison, the problem in the savings and loan industry is easy to comprehend. It is simply that vast amounts of money are disappearing into the black hole of government mismanagement, and the losses must eventually be paid by us. The end result is the same in both cases. Socialism takes root in America. It all began with a concept. The concept took root in America largely as a result of the Great Depression of the 1930s. American politicians were impressed at how radical Marxists were able to attract popular support by blaming the capitalist system for the country's woes and by promising a socialist utopia. They admired and feared these radicals, admired them for their skill at mass psychology, feared them lest they become so popular as to win a plurality at the ballot box. It was not long before many political figures began to mimic the soapbox orators, and the voters enthusiastically put them into office. While the extreme and violent aspects of communism generally were rejected, the more genteel theories of socialism became popular among the educated elite. It was they who would naturally become the leaders in an American socialist system. Someone had to look after the masses and tell them what to do for their own good. And many with college degrees and those with great wealth became enamored by the thought of playing that role. And so the concept became widely accepted that at all levels of American life, the downtrodden masses, as well as the educated elite, that it was desirable for the government to take care of its citizens and to protect them in their economic affairs. And so when more than 1,900 S&Ls went belly up in the Great Depression, Herbert Hoover and a most willing Congress created the Federal Home Loan Bank Board to protect depositors in the future. It began to issue charters to institutions that would submit to its regulations, and the public was led to believe that government regulators would be more wise, prudent, and honest than private managers. It sounds funny reading it. The federal charter became a kind of government seal of approval. The public, at least, was being protected. Hoover was succeeded by FDR in the White House, who became the epitome of the new breed. Earlier in his political career, he had been the paragon of free enterprise and individualism. He spoke out against big government and for the free market. But in midlife, he reset his sail to catch the shifting political wind. He went down in history as the pioneer of socialism in America. It was FDR who took the next step toward government paternalism in the S&L industry, as well as the banking industry, by establishing the Federal Deposit Insurance Corporation. Interesting, eh? Corporation. That's a private corporation, not a government. Not federal at all. Even the name says it, FDIC, and the Federal Saving and Loan Insurance Corporation, FSLIC. From that point forward, neither the public nor the managers of the thrifts needed to worry about losses. Everything would be reimbursed by the government. A house on every lot. At about the same time, loans on private homes became subsidized through the Federal Housing Authority, FHA, which allowed SNLs, oh, sorry. I was thinking of SNL, like the comedy skit. Oh, sorry, got a little weird there for a minute. S and Ls to make loans at rates lower than would have been possible without the subsidy. This was to make it easier for everyone to realize the dream of having their own home. While the Marxists were promising a chicken in every pot, the New Dealers were winning elections by pushing for a house on every lot. In the beginning, many people were able to purchase a home who otherwise might not have been able to do so, or who would have had to wait longer to accumulate a higher down payment. On the other hand, the FHA-induced easy credit began to push up the price of houses for the middle class, and that quickly offset any real advantage of the subsidy. Sounds familiar? It sounds like 2008. In 2008, anybody who can breathe can get a home loan. The voters, however, were not perceptive enough to understand this canceling effect, and continued to vote for politicians who promised to expand the system. The next step was for the Federal Reserve Board to require banks to offer interest rates lower than those offered by S&Ls. The result was that funds moved from the banks into the S&Ls and became abundantly available for home loans. This was a deliberate national policy to favor the home industry at the expense of other industries that were competing for the same investment dollars. It may not have been good for the economy as a whole, but it was good politics. Abandonment of the free market. These measures effectively removed real estate loans from the free market and placed them into the political arena, where they have remained ever since. The damage to the public as a result of this intervention would be delayed a long time in coming, but when it came, it would be cataclysmic. The reality of government disruption of the free market cannot be overemphasized, for it is at the heart of our present and future crisis. We have savings institutions that are controlled by government at every step of the way. Federal agencies provide protection against losses and lay down rigid guidelines for capitalization levels, number of branches, territories covered, management policies, services rendered, and interest rates charged. The additional cost to S&Ls of compliance with this regulation has been estimated by the American Bankers Association at about $11 billion per year, which represents a whopping 60% of all their profits. On top of that, the healthy component of the industry must spend over $1 billion each year for extra premiums into the so-called insurance fund to make up for the failures of the unhealthy component, a form of penalty for success. When some of the healthy institutions attempted to convert to banks to escape this penalty, the regulators said no. Their cash flow was needed to support the bailout fund. Insurance for the common man. The average private savings deposit is about $6,000. Yet, under the Carter administration, the level of FDIC insurance was raised from $40,000 to $100,000 for each account. Those with more than that merely had to open several accounts. So in reality, the sky was the limit. Clearly, this has nothing to do with protecting the common man. The purpose was to prepare the way for brokerage houses to reinvest huge blocks of capital at high rates of interest, virtually without risk. It was, after all, insured by the federal government. In 1979, Federal Reserve policy had pushed up interest rates, and the S&L had to keep pace to attract deposits. By December of 1980, they were paying 15.8% interest on their money market certificates. Yet the average rate they were charging for new mortgages was only 12.9%. Many of their older loans were still crunching away at 7 or 8%. And to compound the problem, some of those were in default, which means they were really paying 0%. The thrifts were operating deep in the red and had to make up the difference somewhere. The weakest S&Ls paid the highest interest rates to attract depositors, and they are the ones which obtained the large blocks of brokerage funds. Brokers no longer cared how weak the operation was because the funds were fully insured. They just cared about the interest rate. And that mindset has seeped into our collective consciousness, isn't it? I used to go to a lot of real estate seminars and stuff, and interest rate was all they talk about. Or most of the seminars, interest rate was all they talk about. Interesting. On the other hand, the S&L managers reasoned that they had to make those funds work miracles for the short period they had them. It was their only chance to dig out, and they were willing to take big risks. For them also, the government's insurance program had removed any chance of loss to their depositors. So many of them plunged into high-profit, high-risk real estate developments. Deals began to sour, and in 1979 was the first year since the Great Depression of the 1930s that the total net worth of federally insured S&Ls became negative. And that was despite expansion almost everywhere else in the economy. The public began to worry. Full faith and credit. The protectors in Washington responded in 1982 with a joint resolution of Congress declaring that the full faith and credit of the United States government stood behind the FSLIC. That was a reassuring phrase, but many people had the gnawing feeling that somehow we were going to pay for it ourselves. And they were right. Consumer Reports explained. Behind the troubled banks and the increasingly troubled insurance agencies stands the full faith and credit of the government. In effect, a promise, sure to be honored by Congress, that all citizens will chip in through taxes or through inflations to make all deposits whole. And that quote was from How Safe Are Your Deposits? Consumer Reports, August 1988, page 503. The plight of the S&Ls was dramatically brought to light in Ohio in 1985 when the Home State Savings Bank of Cincinnati collapsed as a result of a potential $150 million loss in a Florida securities firm. This triggered a run not only on the 33 branches, interesting number, eh? 33 branches of Home State, but on many of the other S&Ls as well. The news impacted international markets where overseas speculators dumped paper dollars for other currencies, and some rushed to buy gold. Within a few days, depositors demanding their money cost $60 million to throw out of the state's $130 million insurance fund, which, true to form for all government protection schemes, was terribly inadequate. If the run had been allowed to continue, the fund likely would have been obliterated the next day. It was time for a political fix. Did I hear a bailout time? Ding, 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 ding. On March 15th, Ohio Governor Richard Celeste declared one of the few bank holidays since the Great Depression and closed all 71 of the state-insured thrifts. He assured the public there was nothing to worry about. All right. That's their singing song, right? Nothing to worry about, nothing to see here. He said this was merely a cooling off period until we can convincingly demonstrate the soundness of our system. Then he flew to Washington and met with Paul Volcker, chairman of the Federal Reserve Board, and with Edwin Gray, chairman of the Federal Home Loan Bank Board, to request federal assistance. They assured him it was available. A few days later, depositors were authorized to withdraw up to $750. Interesting number, eh? The Lahaina fires, they gave $700 to each I don't know if it's each person or each household. And then the California fires in 2025, they gave $770 dollars to citizens. Interesting number. They can withdraw up to $750 from their accounts. On March 21, President Reagan calmed the world money markets with assurances that the crisis was over. Furthermore, he said the problem was limited to Ohio. Yeah, right. So that quote was from Ohio Bank Crisis, that muffled world. U.S. News and World Report, April 1st. April Fool's Day. Interesting, eh? April 1st, 1985, page 11. This was not the first time there had been a failure of state-sponsored insurance funds. The one in Nebraska was pulled down in 1983 when the Commonwealth Savings Company of Lincoln failed. It had over $60 million in deposits, but the insurance fund had less than $2 million to cover, not just the Commonwealth, but the whole system. Depositors were lucky to get 65 cents on the dollar, and even that was expected to take up to 10 years. Oh my gosh. How safe are deposits in ailing banks, S&Ls? U.S. News and World Report, March 25th, 1985, page 74. It still boggles my mind that we're still so ingrained in the banking industry, that we're still putting money in our bank. It's like I don't know if you could call it lesser of two evils, but I don't know, whatever that phrase is. Anyways, sorry, I digress. An invitation to fraud. In the early days of the Reagan administration, government regulators were changed so that the S&Ls were no longer restricted to the insurance of home mortgages, the sole reason for their creation in the first place. In fact, they no longer even were required to obtain a down payment on their loans. They could now finance 100% of a deal or even more. I remember that loan officers advertising for 120% loan of value or something ridiculous like that. Office buildings and shopping centers sprang up everywhere regardless of the need. Developers, builders, managers, and appraisers made millions. The field soon became overbuilt and riddled with fraud. Billions of dollars disappeared into defunct projects. In at least 22 of the failed S&Ls, there is evidence that the mafia and CIA were involved. Excuse me. Fraud is not necessarily against the law. In fact, most of the fraud in the S&L saga was not only legal, it was encouraged by the government. The Garn-St. Germain Act allowed the thrifts to lend an amount of money equal to the appraised value of the real estate rather than the market value. It wasn't long before appraisers were receiving handsome fees for appraisals that were, to say the least, unrealistic. And that was not fraud. It was the intent of the regulators. The amount by which the appraisal exceeded the market value was defined as appraised equity and was counted the same as capital. Since the S&Ls were required to have $1 in capital for every $33 held in deposits, interesting, there's that number again, 33. An appraisal that exceeded market value by $1 million could be used to pyramid $33 million in deposits from Wall Street brokerage houses. And the anticipated profits from those funds was one of the ways in which the S&Ls were supposed to recoup their losses without the government having to cough up the money, which it didn't have. In effect, the government was saying, we can't make good on our protection scheme, so go get the money yourself by putting the investors at risk. Not only will we back you up if you fail, we'll show you exactly how to do it. That's funny. Fallout begins. In spite of it's like parents encouraging their kids to play with fire. Wow, that's scary. The fallout begins. In spite of the accounting gimmicks which were created to make the Walking Dead S&Ls look healthy. By 1984, the fallout began. The FSLIC closed one institution that year and arranged for the merger of 26 others, which were insolvent. In order to persuade healthy firms to absorb insolvent ones, the government provides cash settlements to compensate for their liabilities. By 1984, these subsidized mergers were costing the FDIC over $1 billion per year. Yet, that was just the small beginning. Between 1980 and 1986, a total of 664 insured S&Ls failed. Government regulators had promised to protect the public in the event of losses, but the losses were already far beyond what they could handle. They could not afford to close down all the insolvent thrifts because they simply didn't have enough money to cover the payout. In March of 1986, the FSLIC had only 3 cents for every dollar of deposits. By the end of that year, the figure had dropped to 2/10 of a penny for each dollar insured. Oh my goodness. Wow. That's incredible. Obviously, they had to keep those thrifts in business, which meant they had to invent even more accounting gimmicks to conceal the reality. It's called cooking the books in bookkeeping lingo. Postponement of the inevitable made matters even worse. Keeping the S&Ls in business was costing the FSLIC $6 million per day. Wow. And that was from Fizzling FSLIC by Shirley Hobbs Shibla. Barron's, February 9th, 1987, page 16. By 1988, 2 years later, the thrift industry as a whole was losing $9.8 million per day. And the unprofitable ones, the corpses, which were propped up by the FSLIC, were losing $35.6 million per day. And still, the game continued. By 1989, the FSLIC no longer had even 2/10 of a penny for each dollar insured. Its reserves had vanished altogether. Like the thrifts it supposedly protected, it was itself insolvent and looking for loans. Oh my gosh. It had tried offering bond issues, but these fell far short of its needs. Congress had discussed the problem, but had failed to provide new funding. The collapse of Lincoln Savings brought the crisis to a head. There was no money, period. The Fed usurps the role of Congress. Oh no, sounds like a hostile takeover. In February, an agreement was reached between Alan Greenspan, chairman of the Federal Reserve Board, and M. Danny Wall, chairman of the Federal Home Loan Bank Board, to have $70 million of bailout funding for Lincoln Savings come directly from the Federal Reserve. This was a major break in precedent. Historically, the Fed has served to create money only for the government or for banks. If it were the will of the people to bail out a savings institution, then it is up to Congress to approve the funding. If Congress does not have the money or cannot borrow it from the public, then the Fed can create it out of nothing, of course, and give it to the government. But in this instance, the Fed was usurping the role of Congress and making political decisions entirely on its own. There is no basis in the Federal Reserve Act for this action, yet Congress maintains silent, apparently out of collective guilt for its own paralysis. Finally, in August of that year, Congress was visited by the ghost of FDR and sprang into action. It passed the Federal Institutions Reform and Recovery Act, FREA, and allocated a minimum of $66 billion for the following 10 years. Interesting number, 66. $300 billion over 30 years. Of this amount, $225 billion was to come from taxes or inflation. And $75 billion was to come from the healthy S&Ls. It was the biggest bailout ever, bigger than the combined cost of Lockheed, Chrysler, Penn Central, and New York City. In the process, the FSLIC was eliminated because it was hopelessly insolvent and replaced by the Savings Association Insurance Fund. Also created was the Banking Insurance Fund for the protection of commercial banks, and both are now administered by the FDIC. As is often the case when previous government control fails to produce the desired result, the response of Congress is to increase the controls. 4 entirely new layers of bureaucracy were added to the existing tangled mess. The Resolutions Trust Oversight Board to establish strategies for the RTC, the Resolution Funding Corporation to raise money to operate the RTC, the Office of Thrift Supervision to supervise thrift institutions even more than they had been, and the Oversight Board for the Home Loan Banks, the purpose of which remains vague, but probably is to make sure that the S&Ls continue to serve the political directive of subsidizing the home industry. When President Bush signed the bill, he said, this legislation will safeguard and stabilize. Oh gosh. I'm sorry, I can hear the broken record over and over again. This legislation will safeguard and stabilize America's financial system and put in place permanent reforms so these problems will never happen again. Moreover, it says to tens of millions of savings and loan depositors, you will not be the victim of others' mistakes. We will guarantee that your insured deposits are secure. Was it Bush that said, fool me once, shame on you, fool me twice, or whatever? What is this, the 10th time already that fooling the public? I lost count. Oh, sorry, that quote from Bush was from Review of the News, the New American. September 11, interesting date, eh? 1989, page 15. The estimates are slightly wrong. By the middle of the following year, it was clear that the $66 billion funding would be greatly inadequate. Treasury spokesmen were now quoting $130 billion, about twice the original estimate. How much is $130 billion? In 1990, it was 30% more than the salaries of all the school teachers in America. It was more than the combined profits of all the Fortune 500 industrial companies. It would send 1.6 million students through the best four-year colleges, including room and board. And the figure did not even include the cost of liquidating the huge backlog of thrifts already seized, nor the interest that had to be paid on borrowed funds. Within only a few days of the announced increase, the Treasury again revised the figure upward from $130 billion to $150 billion. As Secretary of Treasury Nicholas Brady told the press, no one should assume that the estimates won't change. They will. Indeed, the estimates continued to change with each passing week. The government had sold or merged 223 insolvent thrifts during 1988 and had given grossly inadequate estimates for the cost. Financiers such as Roland Perelman and the Texas investment partnership called Temple Inland Inc. picked up many of these at fantastic bargains, especially considering that they were given cash subsidies and tax advantages to sweeten the deal. At the time, Danny Wall, who was then chairman of the Federal Home Loan Bank Board, announced that these deals took care of the worst thrift problems. He said the cost of the bailout was $35 billion. The Wall Street Journal replied, wrong again. The new study, a compilation of audits prepared by the Federal Deposit Insurance Corporation, indicates that the total cost of the so-called class of 88 will be $90 billion to $95 billion, including tax benefits granted the buyers and a huge amount of interest on government debt to help finance this assistance. But the 1988 thrift rescue's most expensive flaw doesn't appear to be the enrichment of tycoons, Rather, it's that none of the deals ended or even limited the government's exposure to mismanagement by the new owners, hidden losses on real estate in the past, or the vicissitudes of the real estate markets in the future. And some of the deals appear to be sham transactions in which failing thrifts were sold to failing thrifts, which were failing all over again. Although the thrifts proved to be in far worse shape than the bank board estimated, Mr. Wall defends his strategy for rescuing them with an open-ended assistance. We didn't have the money to liquidate, he says. And that quote was from audit report by FDIC shows Wall's estimates for thrift bailouts in 1988 were wildly low by Charles McCoy and Todd Mason, The Wall Street Journal, September 14, 1990, page A-12. When Congress passed FERIA the previous year to safeguard and stabilize America's financial system, the staggering sum of $300 billion was authorized to be taken from taxes and inflation over the following 30 years to do the job. Now, Federal Reserve Chairman Alan Greenspan was saying that the true long-term cost would stand at $500 billion, an amount even greater than the default of loans to all the third world countries combined. The figure was still too low. A non-biased private study released by Veribank, Inc. showed that when all the hidden costs are included, the bill presented to the American people will be about $532 billion. And that quote was from SNL Industry Rebuilds as Bailout Reaches Final Phase. Veribank News Release, Veribank Inc., Wakefield, Massachusetts, January 12, 1994, page 2. The problems that President Bush promised would never happen again were happening again. And we will stop here for now. I hope you enjoyed that. Thank you so much for joining us. And we will continue part 2 next week. In the meantime, hope you all have a great week and stay safe out there. Okay, bye-bye now.